Okay, great, guys, great. Looks like the sound's okay. Also looks like the slide is okay. Now let's just quickly go through our disclosures. Thank you everybody for joining. It's always great to have you here. This presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation, or endorsement of any particular security, chart pattern, or investment strategy by forex.com. The presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, are not available for US residents due to regulatory reasons. Okay, guys, let's get started. Let me just shift a few things around on my desktop here. Slightly, oh, what's happened there? Here we go. All right. So I think after, by the way, guys, if anyone has any questions or want to mention something even midway through, please do so in the chat box, because I tend to look at that one a bit more than I do the Q&A box for some reason. But you can always send that to everybody, or you can send it just to FX Street Admin or just to me or whatever. So it should be fine. Okay, so getting started. Now, what is this? This is sterling yen. Yesterday, we put out a piece on sterling yen, and I will send you a link to it now. It's just on our website. I will send you a link. It was just about the pound generally gathering strength. And indeed, we've seen that actually today. So we've seen the pound continue to do well. Okay, Pan, I'm not sure what you mean about book. Now, there is another Kathleen Brooks who writes books called a Bluegrass series. That's not me, just to put that out there. The FX side of things are is just, my book is totally different to that, but a lot of people, I get tweets from a lot of these other ones, big Bluegrass followers. So I've never read one of those. Maybe that's what you read, but that is not me. Okay, so sterling yen, as you can see, I've sent you a link there. Please do look at it, about sterling yen, about what we were looking at, how we felt that, you know, yesterday it was coming under pressure, but it bounced ahead of the 50-day moving average, or the green line on this chart, and it's now looking like it's going back towards that 174.80 level. It's got back above 174 already. The highs basically of the start of the year, the very start of the year. So obviously the Japanese Tankan survey, we did say it in that link. We thought that it was a little bit too optimistic. And it did end up being coming in weaker than expected, and we felt that, you know, there were maybe a slightly disappointment in the Tankan coupled with strong GBP could really boost sterling yen in the coming days, and that key technical support 172.08 50-day moving average, well 174.85, so 174.85, that's the high from the 2nd of January, is the key level to watch on the upside. So, you know, as you can see, getting very much to the top of the range. Obviously, a breakout ahead of this 174.80 level takes all the, you know, we'd have to stretch our charts back even more. You know, take us really back to, you know, some significant highs. Sterling yen looking pretty strong there. Just looking at sterling generally, obviously yesterday, the reason why I even looked at sterling yen is because we saw that pop higher in cable. When cable managed to get above that 171, it's still looking very, very strong, right? Take it on an hourly, there's not much getting in the way right now. We're pausing for breath a little bit around about 171, and then we just shot right higher, and that was helped by some better economic data that came out of the US this morning. We saw some better manufacturing PMI. We also heard from those macro-prudential measures for the housing market. I'm sure a lot of you were looking at it. They were ended up being fairly toothless, and people were talking much more about you know, the need for interest rate rises that helped push sterling higher as well. And I guess the one thing that we're running into, so it does seem like the fundamentals very much on the side of sterling. The dollar obviously still, you know, quite weak, trading very, very soft. We don't think it will continue to do that, but certainly, you know, the pound is very much in control here. If you look at the RSI, though, we are pointing out a couple of things. Number one, we are in overbought territory. We're above 70 in the daily RSI, well above it in the hourly RSI. As you can see here, the market's not always going to listen to RSIs. Sometimes it doesn't, just recalibrates itself on its own. But cable, even when it's quite a rapid rally, it certainly does move sideways, and we have seen that. So it's had this big burst on the back of not very much really, and mostly it was on the back of a technical move yesterday, and now we're kind of pushing forward. But if I just do a few bits. Actually, it might be better for me to look at my other chart. Just oh, here we go. I hope everyone can see this. This is now a Bloomberg chart with a black background. If I go to a 5-year, in fact, I have to go more than that. If I go to 2001, the last time we were here, obviously, was back in 2003. Between 2003 and 2004, it didn't take very long for us really to get to 190. As you can see here, we're at 170 in November 2003, and we got to 190 in February 2004. So it's a very some very big moves going on there with the pound. Will the same thing happen again? I mean, we'd never advocate that history repeats itself. But technical analysis does push you to look at past price action and try to infer from that what could potentially happen in the future. And one thing that means is that there isn't, as you can see, it also fell through 190 to 170 very, very quickly. That was in a matter of days. And that was a different period, right? But what it does show you is that there's not a whole lot of technical indicators between now and then. So there's not a whole lot of resistance in our way. So that's why, that's how we're inferring what happened in the past, to see if that could happen to try and get an edge really on what could happen now. We would say there's not too much in terms of technical resistance between 180 and 190. Now, there is a lot of fundamental things that could get in the way there. Number one, you could get a shift in tone at the Federal Reserve. Number two, maybe the Bank of England chicken out of hiking interest rates. You could get a slight economic turn down in the UK. We don't think that's likely at the moment. The economy is doing very, very well. So for those of you who look at the PMI data, so the manufacturing sector in the UK has always been a bit troubled, shall we say. Looks like it's recovering, and it seems quite immune to this strong pound. So the average manufacturing PMI for the second quarter was 57.2. That's up 1 whole point from Q1 when it was 56.2. So a lot of people saying, oh, well, the UK economy, it has to come under pressure, or it has to slow down at some point. It doesn't seem like it's going to do that anytime soon. Certainly doesn't seem like that's on the cards for right now. So that's certainly something that we just point out. But that doesn't mean that there aren't, some levels, certainly some levels to watch. There are some key levels to watch in cable for sure. Resistance now at 173.32. 173.32 is the 50% retracement of the November 2007 to January 2009 bear trade. So if I try and draw it on here, that was from that peak when we got to 211 at the extreme, and then we got to a low. Sorry, let me just try and drag this down. There we go. So yeah, 173.32 is a 50% retracement of that move. So again, quite significant. I'm not, that could certainly get in the way. So it's this retracement resistance that we're looking at here. That's a key level. But support in terms on the downside right now is 169.53. That's the low from last week, the low from the 25th of June. And then below there, you're getting 167.38, which is the low from the 11th of June. So as you can see, there is some resistance coming up. It's not going to go up in a straight line, that's for sure. And if it was to pause for breath, 50% fibs are looked at by the market quite closely, so certainly worth watching there. Let's also take a quick look at dollar yen. I know that a lot of you will have probably been looking at dollar yen. A lot of you certainly will have been looking at the Tankan coming out. I know that there are some fans of that who have joined. Well, hopefully they've joined. But as you can see, looking really, really boring. Like, how do we get a little bit more volatility. As you can see, everything's pretty much flatlining. The MACDs are flatlining. The moving averages are flatlining. The candles are quite narrow. There just isn't too much excitement there. This isn't where the excitement is. That doesn't mean things couldn't change. We've got non-farm payrolls on Thursday this week because of the 4th of July holiday in the US on Friday. And that could have quite an interesting development, really. The market is expecting 215,000, which would, if true, would be the 5th consecutive month of plus 200,000 jobs numbers in the US. That is something that suggests a strong economy to most people, and would suggest that maybe the Fed need to actually start thinking about it a bit more, and start thinking about maybe turning a little bit more hawkish. Now, as you can see here, the 200-day moving average comes in at 101.74. We fell through that last week on the back of that weak revision to Q1 GDP, where it was down nearly 3% in the first quarter. But the downside has been fairly limited. This 101.20 level is still very much in play. It has held consistently 4 times now since March. Well, 1, 2, 3, 4. Alexandru, you're saying you just shorted dollar yen based on, by the looks of it, some quite short-term indicators. I think that's probably a very good so very, very short term. Well, we wish you the best of luck in that, and possibly while you were looking at that, obviously let's bring up our short-term chart to try and see what you're looking at as well. You're looking at the 15-minute chart, am I correct? Let me put in a MACD, hang on. I think that's you've probably done quite a good move there. It does look like dollar yen is, oh, sorry, this is cable, my fault. Sorry, I wondered what you were saying. Dollar yen is, as you can see, yes. So dollar yen, it looks like it could potentially just be, after making that mini recovery back to 101.60, it could potentially falter at that 200-day moving average, which comes in at 101.70. So, John, you're saying all about gold and all right. Weak dollar. Do you think the dollar index will come back this week? Well, the dollar, it can't stay weak forever. That's the one thing we do know. And I think it's, what we know is that it reacts very much to kind of fundamentals, probably even more so than technicals, actually, the dollar. And that's going to be dependent upon what comes out of the non-farm payrolls. Put it this way, if we get non-farm payrolls, then a very weak non-farm payrolls number, then the dollar is likely to come under pressure. However, the same is also true if we get a very strong number, 250,000 plus. I just don't see how we couldn't have a very significant move. I think in that environment, I think euro dollar would be very under pressure, because obviously its relative central bank stances now. It's quite a big part of the. Or what should I say? It's quite a big theme in the markets. And so hence, if you've got the ECB still leaving the door open to more accommodative action, compare that with essentially what the, if you get a good jobs number, the Fed may have to start hiking soon, we think, and that should weigh on euro dollar, we think. And again, could push up should push up dollar yen, because one of the things weighing on dollar yen has been this, which is the yield. So yield is one component of many that make up the price of a commodity. Okay, so John, you're asking about gold. Just bear with me 1 minute. I'll just go through the dollar now. So yield is one. Other things are things like credit risk, growth, potential, political, geopolitical, etc. Quite a lot of things go into build up or go into the value of the currency. So as you can see here, this is treasuries. Treasuries have fallen quite dramatically there. This is the 10-year treasury yield. And if yield is one part that makes up a currency's value, then yes, the dollar has been really under pressure because these yields have been falling, have not been managed to sustain any gains to the upside at all. And as you can see, we're still, we lost that 2.6 handle. We've been to a high of about 2.65 over the past month. It's really quite low, and that's also weighed on the dollar. So when I show you the dollar index here, As you can see, it's a very similar kind of shape. So it's been under pressure. The dollar index, as you can see, gone through all of its moving averages, is managing to find a little bit of support around about that 79.80 level. It hasn't got as low as the 79, so the low of the year so far, of the last 12 months, happened on in May, when we got down to 78.90. So we haven't got back down to that level. So there is further to fall on the downside if that's ends up what happens. But I think, John, what you were saying is that the gold is that dollar can't stay low forever, and obviously a stronger dollar could weigh on gold price, could weigh on the oil price. At the moment, if I just put this in one window, and then I pop up my other one, yeah. And put up, what should I put up? Brent. As you can see, Brent has actually not had a great relationship with oil. With the dollar. I'll just bring these down. Sorry, bear with me, guys. It hasn't been particularly strong. For example, we saw the dollar and oil come off last week, and like for the last few sessions, both together. So one wouldn't necessarily think that if you've got a weaker dollar, and then that can sometimes push up the price of commodities. So that's not always the case. So it is basically, John, that is one way of looking at the relationship, that obviously any commodity priced in dollars will be impacted by the value of the dollar. So if the value of the dollar is stronger, you need fewer dollars to buy that barrel of oil, hence the oil price falls. If it's and vice versa, right? If the dollar's weak, you'd think you'd need more dollars to buy that barrel of oil, hence the price of oil would rise. But it doesn't always play out that way. Okay, that's just one element of that relationship of that price, and that relationship isn't always a clear cut. So I wouldn't just trade oil or the dollar based on which way one of them were going. That's for sure, because sometimes that doesn't happen. So I'm glad we've just figured that one out. And that's the same with gold as well, actually. But just taking a look at oil here, I mean, my colleague Fawad really does a lot of the oil stuff. You can find a lot of it on the website. I've sent you the link earlier, so just go back and press on that. But at the moment, it looks like with problems in Iraq, we could moderate just back to that 110 level, maybe back to that top of that range before all those Iraq crises kind of broke out, before we saw these big daily moves higher in oil. It seems like the volatility is very, very low still. It hasn't caused a problem, so we could potentially we may moderate. This is Brent, by the way, going back to 110. And let's take a quick look at gold. Gold has been interesting. Obviously, gold rose on the back of safe haven demand last week, or in recent weeks. It's got above some key levels, some key resistance levels, and it was high yesterday, for example. It's obviously also reacting to the Federal Reserve, to them obviously staying very, very loose for longer. We know that there is some inflation. We believe there's inflation pressures building in the US, but the Federal Reserve just isn't mentioning it. For us, they're going to have to, and they're going to have to play catch up by doing that. And obviously, gold is an inflation hedge, so that's another thing. Often these commodities, guys, they have various different attributes. They have different elements to their relationship, to their price, different factors drive their prices. So, for example, you've got gold as a safe haven, gold as an inflation hedge, gold as, what's going on with the dollar, that can impact gold, what's going on with geopolitical, what's going on with stocks, etc. So right now, for us, we think that there should be, hang on, there you go. You should be able to hear me again. Great, you can hear me now. For us, gold, because we do think that the Fed is probably being a bit too dovish. That should be positive for gold. And any move back to that 1304 level, maybe even 1287 level, could be used as a buying opportunity. But we think the owners could be high, or the outlook could be higher for gold, and that's largely because of what's going on in the US. And if they consistently say that they're not going to do anything, then really that's going to just lead them to have to play catch up down the line. Someone's Maxi is asking me to look at dollar Swissy. I'll look at dollar Swissy now, actually. Why not? I like a bit of dollar Swissy. Oh, sorry. So dollar Swissy has been, I'll just put up my chart. This is an annual chart on obviously on Bloomberg. Obviously, it's kind of extended its weakness. It's traded all the way. It traded below actually still below 88.90. A lot of people, that was kind of a stop level, so that triggered some further downside when we got back down there. Next support is probably the 88.30 level, which is the 62% retracement of the May to June recovery. If we get a close below there, then we'd be, more than likely going through another bear, another leg lower for this pair. Maybe a deeper sell-off down to the 87 level, which was the March low, as you can see here. That low, which was on the 13th of March at 86.99. That's the next level if we get there. And let me just draw in that fib level. So the May to June recovery, as you can see, 61.8 now. 61.8% retracement of that level is 88.31. So that's our next level. We're currently trading 88.66. So for those of you short-term traders, then I would certainly look at that 88.30 level. If we get through there, that's quite significant and does suggest maybe a return to those lows from March earlier this year. So do watch out for that one. It's the move is trading in essentially been trading in a range with a bearish bias, and that we could certainly see some further downside there. Now, shall I also take a look at Aussie, because the Aussie is always well liked, I always find. Aussie, we are having a really nice push higher. There was some better there was some positives out of China. There's been some positives as well out of Australia itself. All of this is, just bear with me, guys. All of this is helping the Aussie to recover. It looks like it's decisively broken out of that range, actually. Obviously, it's we've got the RBA meeting. They kept everything on hold. They didn't sound too dovish. They didn't sound too dovish either. So, overall, it was, fairly all right. 94.61 does seem to be holding. Now, that's the high from April. We are going to be watching that very, very closely, because the daily close above there would be very bullish for Aussie dollar. So as long as we, basically this is a wait and see moment with Aussie dollar. If we can get above 94.61, that April high, as I mentioned, then we would expect this pair to extend further gains, maybe back towards 95.5 area, 95.45, say, which is the November 6th high from 2013. Then you've got 97.58, which takes you all the way back to these highs over here. Until then, however, if we do falter at this 94.60 level, then we could see some further weakness, maybe just some more kind of, light rolling hills, really, is what Aussie looks like. So if we do falter at this level, then 92.06 is like the low of this range. Comes in around about here. So that's kind of the range that we'd be trading. A lot of people, it doesn't seem like there's a lot of people with too much interest on the upside for Aussie. I think that it's really, people are still expecting it to trade in a bit of range. Obviously, the RBA today they certainly weren't dovish. They aren't going to act one way or the other anytime soon. So I think that's something worth watching. So that's our Aussie. Maxi, sorry, you're asking me to go back to dollar Swissy, saying that there's. Let me bring it down. I can bring up then my hourly chart. In the hourly chart, no more retracement is due in dollar Swissy. Yes, because obviously this is just an hourly chart, so you need to get you need to really get the look at your retracements on the daily, I think. Otherwise it's a completely different retracement, right? Because I'm looking at the retracement from May to June, so we can't quite go back there for this chart. Okay, I'm going to leave that there though, and leave you with that 88.30 level. Now, Someone's asked for euro dollar. Of course, we can look at euro dollar. It's a big week for euro dollar. We've got the ECB meeting, and it's now testing its 50-day moving average. We've had a big push higher. It's been helped certainly, or been aided by a very weak US dollar, been aided as well by cable jumping higher, which, because think of it like kind of fractals really. When cable moves higher, that's the dollar weakening, and then that weakness can seep into other crosses as well. So hence why we've seen euro also pick up on the back of that. We've also had some fairly decent data out of the Eurozone. We had better data, so it was a bit of a mixed bag, the PMIs. We had upward revisions for France and Spain, downward revisions for Germany and Italy. Looks on paper anyway that the periphery is actually outperforming the core. Spain in particular is doing very, very well. They might not be great at football, but they're certainly very good here. They're certainly very good with their PMIs. Remember, Spain is the fourth largest economy in the currency bloc, so what it does matter. So that's very good. So just looking at euro dollar here, as you can see, we are testing that 50-day moving average. Let me pull up my other chart as well. There are stops at one that we have heard. There's a lot of stops at 137. That could trigger maybe some profit taking at that level. We could see it. One would expect it to. We've got above the 100 and 50-day moving average. The 100-day moving average comes in at 136.75. The 50 at 136.89. So we're testing that level right now. If we could stay above it, that would be a very bullish development. But as we said, there are stops there that are worth, certainly worth pointing out. The other thing, of course, is the MACD is back above its zero line. That's quite positive from a stochastic point of view. And obviously closing above that 136.90 level is quite significant. If we can, again, if we do manage to get through 137, that would suggest that we've got a bit more of a prolonged recovery. And so obviously any kind of rejection of it, though, we could fall right the way back to where we were. Just bringing up the euro and that MACD, as you can see, yeah, we're just above the zero line there. That suggests that momentum has shifted. And this is the daily MACD, so it suggests that maybe medium-term momentum has shifted. A lot of people are short euro. People aren't just jumping into it. It's definitely benefiting in some ways from what's going on elsewhere, and also from no negative surprises out of the eurozone. And that can always, of course, just keep people on their toes a little bit. So that's euro dollar. As I said, it's kind of a waiting game. We had the big move yesterday. If we can get above 137, then it could, we could extend our gains maybe towards the 138, 139 levels. If we can't, then we could retrace back to that 134, 135.20 level, which was the low from the 13th of June. Okay, are there any other questions? Can I help anybody with anything else? Okay, guys, it doesn't look like there's any more questions. I know a lot of you were getting involved. So, Kiwi, I'll look at Kiwi. That will be my last thing. Kiwi's been kind of interesting, right? Both central banks try to talk down their currency, but it doesn't work. So yet again, we've got above this key level, but we are rejecting 88. Let me just bring up my other chart as well. So even though we made another stab at 88, we are still faltering at it. Now, the uptrend is still in place, but it is it's struggling just a little bit. Now, Jay, I've already spoken about yen, so I won't be bringing that up again. But as you can see, that 88 level is an enormous level of resistance there. We think any pullbacks will be shallow because at the end of the day, this is a good trade. This is in an environment where relative central bank stances mean something, then the Kiwi should do well because the RBNZ are hiking interest rates. Now, the other one that we like is Kiwi yen. It's your classic kind of carry trade. Classic carry trade, as you can see, faltering just a little bit, but it's, we're hitting two key resistance levels. So how we get on from there is going to be really critical. If we can get above 90 in Kiwi yen, get above 88 in Kiwi US dollar, then that is, obviously a very positive development there. Let me probably leave it there. So basically, John, you're saying you had a bad start to this week. Still got plenty of time. Indeed, still lots of opportunity as well. It's all just about timing, and because we're approaching some key levels right now, it's maybe better to just sit on the sidelines until we find out, we know whether or not we're one way or the other with those levels. Thank you, Ray. You're always join our webinars. We really appreciate you joining. But guys, I'm going to leave it there. Thank you so much to everybody for joining. Do join us next week for more, and good luck and enjoy the rest of your trading week. Thanks, everyone. Bye-bye.